Imagine, just for a moment, the President of the United States standing before the nation at a White House podium, delivering a thunderous demand that the most influential banker in the world, the chair of the Federal Reserve, immediately step aside. Visualize the leader of the free world not merely criticizing this central figure for catastrophic economic mismanagement, but actively igniting a storm of controversy over allegations of reckless overspending and accusations of misleading Congress under oath. Now listen as the shockwaves from this confrontation reverberate through every major trading floor, from Wall Street in New York to the City of London, from bustling Tokyo to financial powerhouses in Frankfurt, unsettling the bedrock of global finance. This is not the opening scene of a political thriller. This is reality unfolding before our eyes, and it raises questions that strike at the heart of your financial security. Is the independence of America's central bank under threat? And what would this mean for your savings, your employment, and your economic future? At the center of this institution sits the chair, currently Jerome Powell. The chair's decisions, whether to increase, lower, or maintain interest rates, impact nearly every aspect of American economic life. These choices affect the rates on your mortgage, the interest on your credit cards, the value of your retirement fund, and even the strength of the dollar you carry in your wallet. When the Fed speaks, the entire world listens and reacts. That is why the current political maelstrom swirling around Powell is so significant, and why its consequences could be far-reaching. Recently, the cherished independence of the central bank has faced perhaps its most severe test in living memory. Former President Donald Trump, renowned for his brash approach and willingness to upend established norms, has unleashed an aggressive, ongoing campaign against Powell. Trump's central grievance revolves around monetary policy. He insists that Powell's refusal to dramatically cut interest rates is choking off economic growth, keeping borrowing costs painfully high, and costing the United States hundreds of billions of dollars, a claim that has been repeated in fiery public statements and private notes alike. This campaign reached a new climax when earlier this week, a letter from President Trump to Powell was made public. In it, Trump pulled no punches. "You have cost the United States a fortune and you continue to do so. You should lower the rate by a lot. Hundreds of billions of dollars are being lost and there is no inflation." Trump added a pointed nickname, Mr. Too Late, and accused Powell of standing by indecisively when bold leadership was needed. But this high-stakes drama is no longer confined to a debate about interest rates. A fresh front has opened up, accusations of deceptive testimony and fiscal recklessness. Bill Pult, the head of the Federal Housing Finance Agency, has publicly called on Congress to launch a formal investigation into Powell, citing allegations that he misled lawmakers about skyrocketing renovation costs for the Federal Reserve's historic headquarters in Washington, D.C. What began as a nearly $2 billion project has ballooned to an estimated $2.5 billion, reportedly featuring luxury amenities like private elevators, plush dining rooms, and extravagant water features, sparking outrage among fiscal conservatives and watchdog groups. Financial experts are sounding the alarm. Brian Gardner, a respected analyst at Stifel, warned, "Markets will not like interference by any administration. It sets a dangerous precedent." Allison Schrager, a Bloomberg economist, cautioned that these attacks could threaten the very foundation of the Fed's independence, sending shockwaves through already vulnerable global markets. Kevin Gordon, a strategist at Charles Schwab, pointed out that the current market reaction to Trump's economic policies is night and day compared to his first term, with today's uncertainty injecting fresh volatility and unpredictability into every trading session. Why does this matter for ordinary Americans? Let's pull back the curtain and examine why central bank independence is far more than a bureaucratic technicality. When the Fed is free to make decisions based on rigorous economic data and the long-term health of the economy, it can act decisively to tamp down inflation, stimulate job creation, and stabilize financial markets in times of crisis. History provides a stark warning. In the 1970s, relentless political pressure kept interest rates artificially low, fueling runaway inflation that destroyed savings, drove up the cost of living, and ultimately plunged the country into a deep recession. The situation became so dire that it took Paul Volcker, appointed Fed chair in 1979, to resist the White House and raise rates dramatically, a move that finally broke inflation, but only after triggering a painful economic downturn. Let's add some context with numbers that matter. In the past year alone, the Federal Reserve reported losses exceeding $114 billion, due primarily to higher interest payments outpacing earnings from its vast portfolio of government bonds and mortgage-backed securities. If political strife further erodes confidence in the Fed's management, we could witness even greater swings in stock markets, surging bond yields, and rising costs for both consumers and businesses. The dollar, long considered the anchor of the global financial system, could weaken sharply if investors start to doubt America's commitment to sound, independent monetary management. Consider this scenario. The president manages to force Powell out. The White House installs a new Fed chair, someone more sympathetic to political goals and willing to cut rates aggressively, regardless of the longer-term risks. In the short term, this could unleash a boom in sectors like real estate and consumer lending, and stock markets might surge on a wave of easy money. Yet experts warn that these sugar highs often come at a terrible price. History is littered with examples where political interference led to disastrous inflationary spirals, currency collapses, and social unrest. Let's look at global case studies. In Argentina, central bank independence was repeatedly sacrificed at the altar of political expediency. Leaders demanded easy money to goose growth before elections, leading to hyperinflation, currency devaluation, and a prolonged economic crisis that pushed millions into poverty. In Turkey, President Erdogan's pressure to keep rates low has contributed to soaring inflation and a sharp decline in the lira's value. Zimbabwe's tragic episode of hyperinflation in the early 2000s is a cautionary tale of what happens when central bankers lose their autonomy entirely. Even developed economies are not immune. In the 1970s, Britain's central bank was pushed to prioritize short-term political goals, resulting in the so-called British disease, a lost decade of stagnation and high inflation. Yet the debate is not one-sided. Some policymakers argue that, in moments of crisis, a central bank that listens to political leaders can act more swiftly and decisively. During the 2008 financial meltdown, the Fed slashed rates and launched unprecedented quantitative easing programs, moves many credit with preventing a second Great Depression. Critics of excessive central bank independence caution that technocrats, shielded from democratic oversight, can become unaccountable, wielding immense power without checks and balances. This democracy deficit is a recurring theme in debates about the proper scope of central bank authority. So, what happens next? Several plausible scenarios could unfold, each bringing its own set of opportunities and risks. Congress could launch an official investigation, which might uncover evidence of mismanagement or even misconduct. The White House could attempt to reshape the Fed's Board of Governors, nominating loyalists who share its economic philosophy, thereby tilting policy decisions in a more politically favorable direction. Powell might decide to resign voluntarily, aiming to shield the institution from further political crossfire, or he could stand firm, putting the Fed's independence to its most severe test yet. Alternatively, the uproar could subside, as so many Washington controversies do, overtaken by the next breaking news cycle. Whatever the outcome, the repercussions will ripple far beyond the corridors of the Federal Reserve. If the perception takes hold that America's central bank is no longer an impartial steward of economic stability, global investors may begin to demand higher returns for holding U.S. government debt. This would drive up borrowing costs for everyone, from the federal government to ordinary homeowners and entrepreneurs. The chain reaction could mean higher mortgage rates, more expensive car loans, surging student debt, and a weaker dollar that makes imported goods costlier for American families. Certain sectors might see short-term gains. If a more politically attuned Fed chair slashes rates, real estate developers could see a spike in business as financing becomes cheaper. Consumer lenders might report record profits as borrowing surges. The stock market could enjoy a temporary rally as investors pile into riskier assets, betting on an extended period of easy money. However, history shows that such booms often sow the seeds of their own destruction. When inflation rears its head, reversing course becomes a Herculean task, often requiring painful measures that hit working families the hardest. For the average American, these developments are not just abstract debates among policymakers and financiers. The price of groceries, the security of your job, the value of your retirement nest egg, all are influenced by whether the Fed can operate free from political manipulation. Investors should watch for sudden swings in bond yields or the dollar's value. These are early warning signs that markets are losing confidence in the Fed's independence. Homeowners and prospective buyers should keep a close eye on mortgage rates, which could become unpredictable in a more politicized environment. And for everyone striving to make ends meet, remember, Stable and predictable economic policy is your best safeguard against the chaos of financial crises. Let's venture deeper into possible future outcomes. Suppose Congress does launch an investigation and uncovers evidence of mismanagement or false statements. Powell could become the first Fed chair in history to be removed for cause, opening the door to a president-appointed successor whose priorities may be more closely aligned with the current administration. Even if Powell survives, the mere threat of investigation could pressure future Fed chairs to be more accommodating to political demands, further eroding the bank's autonomy. On the international front, America's economic rivals are watching with keen interest. China, for example, has long aspired to position the yuan as a credible challenger to the dollar's global dominance. Any signal that U.S. monetary policy is becoming erratic or politically driven could accelerate this strategic shift, undermining the dollar's role as the world's reserve currency and raising borrowing costs for the United States. Meanwhile, America's allies in Europe, Asia, and elsewhere may grow wary of relying on a currency whose value seems increasingly subject to political whim. Let's not overlook the human element of this drama. Jerome Powell, a former investment banker widely respected for his calm demeanor and steady hand, now finds himself at the center of an unprecedented political storm. Every word he utters is dissected by lawmakers, investors, and central bankers worldwide. The pressure of defending not just his own reputation but the very principle of central bank independence is immense. While Powell maintains composure in public, those close to the institution describe an atmosphere of heightened anxiety and non-stop strategizing behind the scenes. Political attacks on central bankers are, of course, nothing new. In the 1990s, President Bill Clinton famously respected Alan Greenspan's independence, crediting this arrangement with helping to sustain the longest economic expansion in modern history. Earlier, however, Fed chairs like Arthur Burns faced intense pressure from President Richard Nixon, pressure that many historians now blame for the inflationary spiral of the 1970s. What distinguishes the current crisis is the scale and intensity of the attacks, amplified by social media and a 24-hour news cycle, and a willingness by political leaders to question not only policy decisions, but personal integrity and fitness for office. As we consider the implications, it becomes clear the independence of the Federal Reserve is not a trivial matter. It is the cornerstone of America's economic system, the bulwark against inflation, instability, and the temptation to sacrifice long-term prosperity for short-term political gain. Undermining this independence, whether through open political coercion or the threat of congressional investigation, risks unleashing forces that could destabilize markets, erode investor confidence, and ultimately harm the very citizens these policies are supposed to protect. So, what can you do to safeguard your own financial future? Here are several practical steps. Stay informed about developments in Washington, especially regarding the Fed's leadership and policy direction. If you have investments, consider diversifying your portfolio to hedge against rising volatility. Keep an eye on changes in interest rates, as these can affect everything from your mortgage payments to your credit card bills. Homeowners may want to lock in fixed-rate mortgages to guard against sudden interest rate spikes. Above all, remember that the health of the economy depends not only on the latest headlines, but on the strength of the institutions that set policy behind the scenes. Here is a little-known but important fact. While the history of the Federal Reserve is full of political skirmishes, never before has a sitting chair faced such a coordinated campaign calling for both resignation and congressional investigation over a combination of policy differences and alleged personal misconduct. This is, quite literally, uncharted territory in the annals of central banking. As always, we want to hear your perspective. Should the Federal Reserve remain fiercely independent, insulated from political winds? Or is it time for elected leaders to have a greater say in shaping monetary policy? Share your thoughts in the comments below. Make sure to like, subscribe, and ring the notification bell to stay updated with our next deep dive into the forces shaping the global economy. Until next time, remember, in economics, as in life, the most consequential battles are often fought in silence, behind